Hi, good morning, all of you. Today we will discuss US taxation, interest. Later we will move into dividend. So let's move straight into the discussion. What is interest? When you invest in bank or you invest in bonds, you will get a byproduct. It's known as interest. Out of those interests, there are taxable category of interest, exempted category of interest, and we will discuss what those are. Federal government bond. Bonds issued by federal government is out of that bond, if any interest gained on that bond, it is chargeable to tax. There is no exemption. Bonds issued by the industrial development corporations for development of industry. Bonds are issued and earning interest. Nothing doing. We have to pay the interest. Corporates, bonds issued by C corporate, that we will discuss what is C corporate later. Interest earned, it is chargeable to tax. Part proceeds of part proceeds from installment sales. What is those installment sales? If I wish to buy the latest version of Apple 15 Pro Max, the cost might not be affordable for me to buy on ready cash basis. But my desire, I need that phone, I need it, but I don't have fund. Then what will be the recourse? What will be the solution? I need it. Then I will approach for a financial institution, and I will own that phone. I will buy that phone on installment basis. That means I will pay some down payment. Balance amount will be divided into a number of months. If that is the scenario, what will happen? Let us go through, just see what will happen. It will be an EMI, equated monthly installment basis, which have two components. What are two components? One is the principal, another is the interest component. That means I have to pay more when this EMI is closed. I have to pay more money than I buying on a ready cash basis. So those interest element is income for the recipient. It's an expense for me. Expense of mine is income of another person. Financials, it will be in the income. So just understand this concept. Then the interest on late tax refund. What is that? We pay local taxes. If sometime our calculation may go wrong, if we pay higher amount, more than the taxable amount, what will happen after assessment, after completion of those calculations and assessment, this local authority or whatever we paid the tax may refund it. Normally it will take 3 weeks, 1 month, or less than that. Unfortunately, it took longer time. It took 3 months, 6 months, 8 months, whatever. So the governmental authority may pay the interest for the delayed period. What was the normal period and how much delay has occurred? For the delayed period, those interest received along with the refund, those interest elements are chargeable to tax. This will be chargeable to tax. Next, amortization of bond premium discount. So let's discuss an extreme example. Okay, 10,000 bond is face value $100. I'm purchasing a bond, 10,000 US dollar. Sorry, 10,000 number of bonds with the par face value of 100 rupees. how much amount I have to pay, how much dollar I have to pay in this transaction to buy. I have to pay 10 lakh US dollar for purchasing those bonds. Okay, the company is good, great demand in the market. So if I want to purchase the bond, I have to pay $10 premium. 110 if I pay, then only I could be able to purchase the bond. So in this transaction, how much I have to pay? 11 lakh US dollar I have to pay. And assuming further the redemption period is 10 years, 10 years. In these transactions, I incurred a loss actually. 10 rupee premium paid is a loss for me. So the federal taxation allow me to write off 1 lakh additional I have paid. This 10 rupee for 10,000 number of bond, this $10 and it will be worked out 1 lakh and the period is 10 years. So what will happen? I can able to write off $10,000 every year, and assuming further that the bonds yield an interest of 10%. So 10 lakh ka 10% will be 1 lakh rupee interest I will earn. Against that interest, this premium element I can set off. Then remaining amount will be the balancing figure. Adjusted this balanced figure only, I record to pay the tax. And take another example. Face value $100. Now it is available for $90. So what will be the implication? There is a profit for me. If I pay $90, I will get the $100 bond. So there is a profit. There is a profit. $10 ka profit. 10,000 number of bond. How much my profit? 1 lakh US dollar is my profit. I'm dividing is 10-year period each year. Each year, how much I will yield? This discount, this profit, extra profit, how much I will yield? Same 10,000 US dollar I will yield. And I receive 10% interest. 10 lakh US dollar value, 10% will be 1 lakh. And that 1 lakh interest plus this amortized portion will become my income. So in short, let's just move through this diagrammatic example for summing up. Interest received from federal government bond, interest yield from industrial development bond, interest yield from corporate bond, part proceeds of EMI, that interest component, delayed payment by the local authorities or local government or whatever, amortization setting off and adding example. Now let's move the tax-free interest. What are the tax-free interest? Interest yield on the bonds issued by the local authorities, panchayat, municipality, corporations, or obligations of local authority. They issuing a bond. They have an obligation. For fulfilling that obligation, they need fund. They're raising the fund through the bond. There is a contradiction actually. There is a contradiction here. Federal government bonds are taxable. Federal government obligations are interest yield on those bonds are taxable. But interest yield on local governments are exempted. Why? Because the US government promote fundraising, mobilization of fund of local bodies, development of local bodies. They are to promote, to attract more investors in the bonds of these local bodies. They charge tax on the interest of the federal bond. But those, if we divert our attention from the bond of federal government to the local government, in order to yield tax benefit, more people will be attracted towards this local authority bonds. It is tax free. Other one, the bonds of US possessions. In India, as far as India concerned, there are the union territories called Andaman Nicobar, Lakshadweep. Same way, there are certain territory. Guam, Puerto Rico is a Caribbean island. Guam also an island. For their obligation, they want fund for their development or various other purpose. They will issue the bonds. Such bonds, this obligation of US, that are also exempted. Then the other category, US series EE. EE means educational expense saving bond. Educational expense saving. If I have a son whose age is, now the age is 9 years, for the education purpose, higher education, when he attained the age of 19, the time for higher education. As a prudential basis, what I will do, I will invest now on those bonds on a lump sum amount, which will be, what will be happen? I won't touch any interest. I don't do anything. When it matured, I will utilize for the higher education purpose, for meeting the educational expenses of my son. Otherwise, that time it may be burn my hands. Nowadays, educations are such a costly business actually. So, as a prudential basis, I am doing this. US series educational expense bonds, but there are a condition. We must understand the keyword of TAMI. In order to obtain this exemption, exclusion, this TAMI condition we should understood. It is used for the taxpayers or dependents higher education purpose, because the bond have a purpose of education, so it should be used for that purpose. Then age limit is also there. It should be touched when I am attaining the age of 24. Other example, I told the age of 19, but here the age limit given is 24. Before I touch that, it will be taxable. Then married. If I have a daughter of 24 years or more, they may be married. In such cases, they have to file the joint return. If they file return separately, also won't get this benefit. Then there is a income requirement, modified, adjusted gross income requirement is also there, and we will go through that later. In sum up, let us just go through, see the diagrammatic explanation. Interest free, tax free bonds, state local government bonds, mutual fund dividend. If I earn mutual fund dividend, it is taxable. However, those dividend I am reinvesting in on the local government bond. I earned in mutual fund dividend, decent dividend. I'm reinvesting on local state government bonds, then it is exempted. Bonds of these territories, union territories, those islands, their obligation and possession, that is exempted. Then educational expense saving bonds. I want to save, I will get the tax benefit also. And what are the condition for that? We must remember the keyword TAMI. And I'm summing up this interest discussion. And thank you for watching this video and have a wonderful day ahead.